All right, here we go. So Alex, just tell me if you can see this and then I'll go to presentation mode. Can you see my screen?
Looks great, Suzanne. Thanks.
All right, awesome. So first off, I want to say a huge thank you to Alex Navarro for asking me to be on tonight for you, his clients, his friends, his family, to share information on just state of the market. And if you saw the invite well, obviously you saw the invite that Alex sent you, you'll know what we'll talk about, which you'll see momentarily. I have a thing for coffee. I almost never say no to a coffee meeting. So we're going to have a coffee theme for tonight. So for tonight's homebuyer webinar, and we'll discuss a little bit of who the heck is this person that's talking to you? When is the ideal time to buy a home? Why preparation is key? Data over drama. And then we'll leave some time at the end for any of the questions that you put in the chat. By recording this, you're all going to get a copy of the presentation. So here's a little bit about me. My name's Suzanne Caldeira. I've been in the mortgage industry for 23 years. I absolutely love it. I got into the industry just to change my career path and ended up finding something that I absolutely love. So I can say, to give street cred, I've closed thousands of transactions, all different types. I'm passionate about educating and guiding people through the process. I believe that there is a gap in knowledge for consumers. And I think sometimes people are scared to maybe speak to somebody like me or speak to a lender. We're just people just like you. We just have we just found a different job that we enjoy. I'm sure if we switched seats and I sat and attempted to do your job, I'd feel insecure as well. We're not here to judge. We're here to guide. I'm a huge dog and animal lover. If I win the lottery, peace out. I'm going to get a animal sanctuary. And I am, fun fact, I'm horrible at math and basic math, and I have no shame over that. So, Alex, when do you think the ideal time to buy a home is?
For me, I think, and for my clients, it's really when you feel like you're ready, when you actually feel like it's within your budget, it's within your, life plan, that you're just ready to stop renting, you're ready to have your own space.
I'll say for those of you that are on here, Alex and I did not speak prior to this, other than Alex asking, "Hey, can you come on and share some values, share some knowledge?" The next slide is the ideal time to buy. It's when you're ready. Don't buy because of FOMO. Don't buy because of fear of missing out. And FOMO can create a bunch of things. FOMO can create that false sense of urgency or trying to fit in with the Joneses. This is historical data from the St. Louis Fed on real estate. I'm always going to be bullish on real estate. I'm always going to be passionate about real estate. However, it has to be your time. Regardless of how passionate Alex is about real estate, how I am about real estate, again, it has to be your time. So what I love about this graph is that it shows you from, somewhere in the 1960s all the way up to now the latest data that I could get was up until the end point of 2023. So yes, there is a little bit of a dip, but I will tell you that towards fall of 2023, we saw rates crest into the eights, almost the mid eights in some circumstances for clients. And that put a little bit of a pause for people because as rates go up, you end up, I forget what the stats are, but as rates go up a point or so, you can sometimes lose close to 1 million homeowners because either they put it on hold or it's no longer affordable for them. One of the key things here is that when you look at the shaded areas, Alex, can you see my mouse on the right?
Yes.
Okay.
Yep.
So when you look at the shaded areas, those are recessions. So if you look during recessionary periods, real estate tends to stay strong. So again, I know what it's done for me personally and for my family and my life and for clients that I've helped. So that's why, it's a passion to help educate people. Now it's an appreciating asset. Now, if you're a long-term renter, don't let this get you discouraged. Use this as fuel to motivate you. Because if you've been renting for a long time and you have a life thing that happens, you can't go and borrow from your apartment. You've got to figure out like, well, how am I going to get money? Am I going to borrow from my 401k? Am I going to max out credit cards or beg family and friends? So what I did with this slide is we're gonna let a couple of people in the waiting room, and then after that, no more waiting room. Because I got bad adult ADD, guys. So what I did was I looked at national averages for rent, which are somewhere around $2,000. Now you look at the Boston market, it can be higher. And these numbers I have on rent might be too low. So I took $2,500 a month in rent. In year one, you're paying 30 grand in rent. In year five, you've spent $150,000 in rent. Year seven, you've spent $210,000 in rent. And year 10, you've spent $300,000 in rent. Again, if you're a long-term renter, use this as fuel. You know, what you can't do is you can't change what happened in the past. All you can focus on is this moment now. And hey, you're taking the time, you're getting educated. So usually that means there's a little bit of interest. So when I was creating the slide, other than really digging all the coffee stuff and the coffee graphics, this slide was in there and I thought it was kind of apropos. So it's a quote from Walt Disney that says, the way to get started is to quit talking and begin doing. So, and your beginning of doing might be different than other people's. There are some people that come to sessions like this and they're ready right away. There's others that need to work on a game plan. And then there's others that say, you know what? It's not for me. I don't want real estate. And if that's you, that's okay. So now I'm going to talk to you about why preparation is key. So preparation means that you're starting with someone like me, a loan officer, someone that can really look at your financials, the doctor of the industry, so to speak. I don't know if you've ever made an emotional decision. Alex, have you ever done anything on emotion and no logic?
I'm really bad at that.
Really?
Yes. It'll be 12 years to get married.
Oh my goodness. Well, I would say he's more of the logical type. Obviously, you know, they didn't get married in 2 minutes. So, you know, when you're not prepared, and this happens almost weekly, we're getting in my team at least 1 or 2 clients that they just found a house that they loved. And either I'm the hero or I'm the anti-hero that has to explain to them, I'm sorry, you can't make the offer because of X. Or I'm trying to piece it together and trying to make it work. And then obviously there are times where it works perfectly. But I believe that preparation is key because you're going to know where you stand. You can take care of any items that may be preventing you from being a ready homeowner now. Or you can get a game plan in place of figuring out, like, even if you're ready now, maybe you tend to be more fiscally conservative and you would feel more comfortable if you had more money in the bank. Even though on paper, I'm looking at you or the lender's looking at you as the ideal client, you may have more comfort having more money in the bank once you start seeing what real numbers may look like. You can understand how lenders look at your profile. And through some other slides, I'm going to help you with some of those items. And you can create a budget around the life you want as well as around the home that you want. So that's why preparation is key, as opposed to falling in love with it first and then trying to figure it out along the way. Now, I'm just going to explain just some differences in, and this is not an infomercial on me subconsciously saying, hey, you've got to use me, but it's just explaining some of the differences on what I see majority of lenders doing versus what we do on our team. Now, if you like how the left side works, great. There are a number of lenders that'll work that way. Majority of lenders process is you're going to fill out an online application. You're going to submit whatever requested documents they need. Lender gives you a pre-approval. You hop in a car with Alex, or you follow Alex, or you meet him at the house, however you guys go look at houses. And then you connect with the lender once you're in contract. Our process slows it down a teeny bit in the beginning, which is client completes an online application. Client schedules a 20 to 30-minute loan consultation, either via Zoom, via something like this, where it's very transparent. They're seeing examples. They're seeing what the loan officer is talking about, or it's done on phone if they're more of an auditory learner. Loan officer is going to ask them a number of questions to try and understand as best as possible. What are your needs? What are your goals? What are some of your aspirations? Pre-approval is given based off of what the client's goals are. Sometimes clients want to see the maximum, other times it's no. I'm pre-approved at 800. We're not going above 7 because, we like to, take long weekends. We have the kid in private school, whatever it is, that's how their pre-approval is going to be. Team stays in touch with the client to help with any recalculations on numbers, to answer any questions. Realtor and client alert when they put in an offer. Loan officer reaches out to the listing agent, the selling agent who's selling the home, to put best foot forward for the client. Sometimes it's one and done. They get the offer. Sometimes they don't. And then once in contract, a call with the loan officer to review, like, hey, all right, let's button up how we're going to design this mortgage for you. Now, what do lenders look at? And so there is some insecurity and there is some misconceptions when it comes to credit. The big fallacy is that a lender running your credit is going to hurt your credit. I have videos on my YouTube on this. It drives me absolutely batty. And I really believe it was a lender who said this, a lender who said, I don't want you shopping for mortgages. When a lender runs your credit, your score may move anywhere between 2 to 8 points. What you see, so many people nowadays monitor their credit. Maybe they use Credit Karma, or maybe they get their credit score from their credit card, or they get their credit report directly from Experian. That report is different than what we see as lenders. So we either see a higher score or a lower score than what the consumer sees. And coincidentally, credit reports, it's in the industry standard that we say they're good for 90 days. They're actually good for 120 days. Because in the old days, it took about 3 months to find a house, and then it took about a month to close. In the Boston market, sometimes you got to close these houses in 10 days. Alex, what's the quickest that you've seen on offers or?
10, yeah, I almost did a 10-day, but usually, we're looking at 3 weeks is pretty quick. And a lot of the, folks that have been in the business for a really long time freak out when they hear that. But, we got to move fast, and lenders like you, Suzanne, can help us do that.
Yeah, it's true. And that is one of the reasons why when you're prepared, when Alex is telling you, hey, it's go time, you got to move fast, you've already done your legwork. So you don't feel like you're being pushed. You may feel it, like you're going to feel anxiety, you're human, you're going to feel those normal emotions, but Alex has prepared you so that way like, okay, strategically, how do we have to do this? Now, with credit, the better the credit, the more choices you have, the better terms, the more various loan products that you can do. So that's why getting ready early is helpful. And I'm probably saying it a little too much about getting ready early. Income, lenders are going to want to look at your income to make certain that there is stability, that, if you're self-employed, we need to see 2 years worth of your taxes or 1 year, depending on the program. If you're a commission or a bonus employee, we need to see what the trends are. I'll give you an example. I have a gentleman that's in sales, and the past couple of years, his income has been declining. He's in the auto industry. And I sent in his file for what's known as upfront underwriting because I didn't feel comfortable, even with the numbers we were coming up with on my team. So I said, hey, I want the person that has the keys to the checkbook to look at this. Is there any additional income? And it was really low as far as the income that was able to be verified. So we came up with a strategy. A lot of times in the car business, President's Day is supposed to be a big weekend for people shopping, plus seasonality. So as weather gets better, spring, summer, he'll be making more money. So we left it that, hey, let's connect in the summer. You have no pressure to move. You're living with family. Let's see what we can use and see if it's a better approval for you. Assets. So the reason we want to look at your bank statements is not because we're nosy. Every year as a lender, I have to take what's known as AML training, which stands for anti-money laundering training. So on the consumer side, there's a lot of fraud where people are filtering money through people's accounts to do fraudulent things. I would like to believe that everyone that is connected to me is not doing that, but I have to keep a healthy skepticism. And that is why I could have made the font bigger, but no cash. So depending on the loan type, there are some loan programs that any undocumented deposits that go over a certain percent of your income need to be verified, or we have to pretend that money doesn't exist if it cannot be verified. Or sometimes it's all money needs to be verified. I'll give you an example for certain state bond programs. Mass housing is one. Mass housing is not too tough, but Connecticut housing, which is known as CHAFA, every single deposit, even if it's a $5 deposit, we have to document, which is a real big pain in the behind. The other reason that lenders look at your assets is we want to make certain that there's no other debts that you're not telling us about. So we see the credit report, but if we see the credit report and we see a payment to Chase Automotive for $550 a month, and you haven't disclosed that, we're going to ask, like, what is that? Do you have a car loan that you didn't tell us about? Did you help a friend out? Like, what is going on? So that's why your bank statements are scrutinized. The other things that get looked at is, how do you manage your money? Are you bouncing checks? Do you have overdrafts? Is your account in the red? So we got to make sure that we're putting good loans out there, and that we're not setting up clients for failure. That is the last thing that anyone wants to do. This next slide is really more of like that, call it that 30,000 foot overview of types of loans so that you can kind of understand some progressions. There is no down payment programs, your state bond programs. There are some instances where a lender like me might not be good for you. There are some city programs that are better if you use a credit union. And a good lender should tell you, hey, I'm not the right fit for this because this credit union has this special state agency program. So make sure that you're working with someone that's honest and is putting your needs ahead of their own. Mass housing is a really good state bond program in the state of Massachusetts. Then is the 3% down programs. Those programs work well for someone that maybe makes too much money for the state bond program. And those programs, 3% down is typically for your condos or your single families. There's renovation financing. So if you're looking at places with Alex and every single house is perfect except one little thing, that could be something. Talk to your lender and ask, hey, do you have renovation financing? For us as a lender, we do all types for VA renovation for veterans, which is no down payment. FHA, which has their 203K, and then conventional products that have renovation financing. Then there's VA loans for veterans. That's a zero down program. Alex, have you had any clients that have been veterans or done a VA?
I haven't finished a VA, but I have had several clients that have gone through the approval process.
Cool. You may have heard of this, you may not. I don't know. Have you ever heard of their Tidewater rule?
No, I haven't.
Okay.
I haven't gotten there yet. Yeah.
All right. So think like rising tides. It's actually called Tidewater. So with VA is at this moment in time the only product, and it's been this way for years, where if the appraisal will not meet value, the appraiser is required to alert the lender, we have Tidewater. We have Tidewater. I'm trying to make value. Not trying. You can't say that. We cannot make value. Please alert the realtors. And at that point, and the appraiser will not share what comparable sales, we call them comps. The appraiser will not share what houses he or she used. They will just simply say there's Tidewater, and then the lender has, I always forget how many days, 48 or 72 hours to get the data from the listing agent and the buyer's agent to work on either making the value work or needing to make an adjustment, or the veteran will need to put a down payment if it doesn't work. So it's a very unique thing with VA loans, and I fight really hard to get them to get those type of offers accepted. My stepdad was a veteran. I get involved with veterans organizations. It's a wonderful product with a lot of misconceptions tied to it. So that's one of the very unique things about VA. And if there's a Tidewater issue, so let's use you as an example, Alex, and you realize that, hey, the house a couple of doors down sold for less, even though it was on the active market, because it was so-and-so's cousin, and that agent told me that. Now, the appraiser might have no idea over that, about that, and that's why. So again, there's so many things, and that's what's good about working with somebody like Alex, because he knows the market. He knows what's going on. He knows those nuances. There's nuances all over the place, especially in Massachusetts. You know, even though it's a large state, you know, I mean, think of all the little subsections of Boston, you know, I could go on and on. USDA is for rural housing. It's an income restricted product. The income restrictions aren't that bad. They end up, depending on the area, coming out to about 110% of the area median income, or AMI. And it does go by total household income. So even if, let's say, for instance, you've got your honey that lives with you, but you don't want honey on the loan, the lender has to ask how much they make, because it goes by total household income. Jumbo loans. Jumbo is as literal as it sounds. It's not a government loan. It's not what's known as a conventional loan. It's a big loan. And in the Boston market, the limit for what's known as a conventional mortgage, I always have to look it up. It's somewhere around 800,000 or above that. Jumbo loans, they're just bigger. So we do those. And I could have had bullets and bullets and bullets and all different types of loan programs. Many times when it's someone's first time, it's usually falling into these categories, and loans for people that are self-employed. Okay, so what do lenders look at? And I'm going to give you an overview of what we're looking at to come up with those determinations. So lenders are going to look at your gross income, so what you wish you could take home. And they're going to look at all your monthly payments, not utilities, not daycare, unless it's a VA loan. VA, and this is also another reason that VA loans are very stable. VA loans have what's known as a, oh my goodness, I always forget, is it residual? Jeez, I don't know. Hey, every now and then I have a brain fart. VA loans do an analysis on how much money you have left over. They take a factor for utilities, and you do have to deduct for childcare expenses. But let's take VA out of the equation. So we're going to look at your gross income. We're going to look at your monthly bills that are on your credit report. We're not going to pay attention that maybe you belong to a country club, or maybe you're paying to have your kid at private school, or maybe you literally spend $2,000 a month going out to dinner. We're not going to pay attention to that. I'll point it out to someone in a consultation, though. We're going to look at your monthly bills. We're going to add your monthly bills to your new mortgage payment, and we're going to divide that by your gross income. A healthy number for a consumer is that your debt to income ratio is no higher than 41% of your gross income. So simple math on this second to last bullet is, let's say your new mortgage payment, your bills, they all come out to $4,000 a month. Let's say your gross income is $10,000 a month. You're at a 40% debt to income ratio. Now, many times in a lender's job, we're using it depends answers. there are times where you could get a 50 some odd% debt to income ratio done. Now, and that may make sense. So let's say, there's the honey that won't put the ring on it and has been with you for 20 years, but you don't want to put honey on the loan. Okay, that can make sense. Or if you just started getting bonus income, but you haven't had a history yet, but yet the trends and how hard you're working looks like it's all going to work. So again, these are general rules. If you want to buy either at your means or below your means, stay under 41%. Know if you're pushing yourself, what's going to work for you. But and Alex will say this to you. The last thing that he wants is you pulling into the driveway and, being angry that he made you fall in love with the house. Right, Alex? Thank you.
Absolutely. All about getting return business.
Yes. Yeah. All right. So let's talk about data over drama. So what I did was, as I was preparing this a couple of days ago, I just said, all right, give me some mortgage and real estate headlines over the past 3 months. So when will the market crash? And that's from US News Real Estate. And then this one from ABC News, millennials, they're priced out of home ownership and they're feeling the pressure. And then this one, if you could see me with my mouse here moving around, I'm moving our heads because they're in the way. Redfin, housing market update. Pending sales post biggest decline in 4 months, dampened by rising mortgage rates. And then a month ago, apparently US News has the best crystal ball because they're going to predict what's going to go on up until 2028. Like, I have been doing this for 23 years. And I'm only saying that more so for reference. I have no clue. I don't know what's going to happen with rates tomorrow. I have an idea, but I have no clue. So I want to circle back to what I started with. The best time, it's when you're ready. And I think it's important. You took a step tonight. You took a step in educating yourself and in finding out, like, well, gee, what is this whole thing about buying real estate and what do lenders look at? So I cannot stress this enough. The best time is when you're ready. Careful with FOMO. Another thing on data over drama, and this one really hits home in part because many employers nowadays are not giving you a pension. Many people aren't really good about maxing out their 401k and saving every penny. And real estate fits into your wealth building. And the average net worth of a homeowner is about $397,000, just under it. The average net worth of a renter is $10,400. And Social Security ain't gonna cut it, unfortunately, when it comes to, just the overall cost of being able to support people's lifestyles. Even if you end up retiring with no debt, it's really hard to survive on that. So, and that's why I'm passionate about real estate, knowing, again, what it's done for myself personally, as well as what it's done for my clients. So Alex, I just want to say thank you so much for asking me to do this. You always are doing things to bring value to your clients. If for those of you that don't know, Alex has an amazing YouTube channel. He puts out educational content frequently that'll really help you understand things to be aware of. And I've learned when I've watched his videos on YouTube. So I'm going to stop this screen share and I'm going to see if there's any questions in the chat. Where's my chat?
Thank you, Suzanne. You're the one who inspired me to get that YouTube channel going, so I really appreciate it. And for all of you out there that we've spent some time together, Suzanne is a really amazing resource. She said earlier something that really hit home and reminded me that there are loan programs that she can't handle, and she's not afraid to tell her clients that, even though it might mean she doesn't get the business. Most lenders are not going to do that for you. She's honest, she's trustworthy, she's fantastic.
Thank you. That means a ton. I want to say thanks for all of you all to be on here. Part of me is excited. You didn't ask any questions. I'm going to get to watch Jeopardy tonight, so I'm really psyched. So everyone have an amazing night. Alex, you have an amazing night, and you'll all get a copy of this tomorrow as well as the recording. I'm going to be reaching out. you don't want me to, just, send me an email. We're adults. And look forward to guiding you in the journey if I get the opportunity. So again, thanks so much.
Thanks, Suzanne. Thanks,
All right.
everybody.
Take care.